Hey, what's going on, YouTube, and welcome back to Tech Conversations. As always, I'm your host, Guillermo, and as always, I'm not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So, I hope you're having a great day today. It is August 5th, and I hope you all saw some great gains today in the stock market. As always, let me know in the comment section below how you guys are doing today. Now, today I want to talk about the difference between credit spreads and debit spreads, and in particular the put credit spread and the call debit spread, and why I prefer the call debit spread over the put credit spread. Okay, now before we begin, I do have a Discord that now has over 1,100 members. Link to that is in the description below. We do offer a free version and a premium version. Premium version is $3 a month, and if you join, you will get access to a bunch of free resources, weekly watch lists, alerts, trades, all that stuff. Go ahead and join if you'd like. Also, remember to smash that like button and subscribe, guys. It really helps out this channel. It really helps these videos, show up to other people on YouTube, so that hopefully they can watch these videos and become a little bit more educated about the stock market before they start investing. Now let's get right into this video. So let's talk about credit spread versus debit spread on AMD. So this is the stock that I'm going to be using for this demo. Remember, if you're new to trading options, I'll put a link in the description below to a video where I explain what trading options is and how it works. Go ahead and check that out. So we're going to go into the options for AMD, clicking on that button right there. And so here are all the options. Okay, now remember, any put credit spread, you're going to sell a put, right? So if you go to sell options and you go to puts, you're going to sell a put. Let's say you wanted to sell this one right here, and then we're going to buy a put. Remember, same expiration date, same type, so another put. We're going to sell a put, and remember, this has to be at a lower strike price than the put that we sold, right? So we would buy a put at a lower strike price than $80. Any call debit spread, we're going to sell a call, right? So let's say you wanted to sell a call on this $80 strike price here, and then we're going to buy a call, again, exact same expiration date, but again with a strike price less than the call that we sold, right? So you would actually go ahead and buy a call less than $80 strike price, so under here, right? And that would be a call debit spread. And so let's try to understand what the differences are between a put credit spread and a call debit spread, because keep in mind these are both bullish strategies, right? And you're going to see this here pretty soon. But which one is better, right? And why? And why do I prefer the call debit spread? Well, let's head on over to the options profit calculator. Okay, again, very helpful resource to help you visualize what happens in a trade, what your max risk is, what your max profit is, depending on what date it is and what the price of the stock is. So I'll put a link to the options profit calculator in the description below. Please check it out and always chart your trades before you get into them so that you understand fully what's happening. So this is the put spread calculator. Okay, and so this is where we're gonna do the put credit spread on AMD. So as you can see, you type in the symbol of whatever stock you're choosing. And so for this, we're doing AMD. You click on get price. It'll tell you what the current price is. And then remember, put credit spread, we're going to sell a put at a strike price, and then we're going to buy a put at a lower strike price. So let's first start off with writing or selling our put. So we're going to click on select option. Remember, you have all your expiration dates up here. Let's choose August 14th since that's a little bit farther out. And let's sell a put here. Remember, puts are on the right, calls are on the left. So we're going to sell a put, and let's choose $80 strike price. So we're going to go to $80, and we're going to click on this, right? So according to this, we're going to sell a put on AMD expiring August 14th at an $80 strike price. And for doing this, we're going to receive 99 cents per share. Remember, there's 100 shares in each contract, and this is one contract. So we're going to receive 99 times 100, or $99 for selling this put. Right, now we're going to buy a put at a lower strike price than this $80 strike price right here. And again, this is going to serve as protection so that in case the price of AMD starts to drop, we don't actually have to purchase 100 shares of AMD at $80 per share. This will, protect us from, the price just dropping to zero and not having to lose or risk as much money. So again, we're going to go to select option. And as you can see, it has to be the exact same expiration date, which this recognizes that. So it's already on August 14th. And again, we're going to buy a put at a lower strike price than $80 strike price. So let's just choose 75. Okay, so we're going to click on this. And so as you can see, we're going to buy a put at a $75 strike price, expiring on August 14th. And so for this, we're going to actually pay 26 cents per share. There's 100 shares in each contract. So we're going to pay $26. And so since we're receiving $99 for selling this put, but then we're paying $26 for buying this put, we're going to receive 99 minus 26, or 73 cents per share. 100 times 100 shares is $73. Okay, and so that's the difference between a credit spread and a debit spread. In a credit spread, you're receiving money up front, right? That's why it's called a credit spread, because you're going to receive a credit. And right here, it's going to be $73. And so let's graph this out quickly. So as you can see, this is a bullish strategy. You want the price of AMD to go up. So if you look at the estimated returns, our max risk is going to be $427, and our max return is going to be $73. And again, just a quick thing here, if you always want to figure out what your max risk is, it's always going to be what the difference between the strike prices is times 100. Right, so 80 minus 75 is 5 times 100, that's $500. That's your max risk. But then keep in mind, you are receiving a $73 credit for this credit spread. And so 500 minus 73 is $427, which is your true max risk. Okay, but your max return is $73, and you're going to receive that up front. Okay, now let's take a look at a call debit spread and see how that looks like with the exact same strike prices, exact same stock. So again, we're going to choose AMD. And so again, this is going to be the credit spread, and then the other one was the put spread. And so as you can see, same concept, but in this case, we're going to sell a call at a strike price, and we're going to buy a call at a lower strike price. So again, let's first start off with selling the calls. And again, we're going to choose exact same expiration as the other one. And again, calls are on the left. So we're going to sell a call. I'm going to choose the exact same strike price we chose for the put that we sold. So we're going to do $80. Okay. So we're writing or selling an $80 call expiring on August 14th. And so for this, we're going to receive $665. But now we're going to buy a call. Okay, so we're going to go up here. We're going to buy a call again at a lower strike price than this strike price. And we're going to keep it the same as this put spread, which we had chosen 75. So I'm going to choose 75. Okay. So as you can see here, this is minus 405, right? So in this scenario, we're going to have to actually pay up front and then hope we make money later on. Where, in the put spread, we receive money and then we hope that we don't end up losing money later on. Okay, and so for this, again, we're going to pay $4.05 per share, since there's 100 shares in each contract. We're going to pay $405 up front. But let's take a look and see, is this a better deal than the put spread? Let's calculate this. So let's take a look at this. Max risk is 405. Your max return is $95. So keep in mind that your max risk here is basically the same as your max risk here, right? Because the formula here still holds. The most you're going to lose is $80. The difference between the strike prices times 100, which again is going to be 5 times 100, which is $500. Okay, that's your max risk. But look at this. Your max return here can be $95. It's going to be... Actually, no, my apologies. Your max risk is going to be what you paid up front. Okay, $405. That's your max risk. But look at your max return, $95. Right? In comparison over here, your max risk is higher, $427. Your max return is lower. Right? These are both bullish strategies. right? You can look at these. These are both bullish strategies. You want the price to go up. I mean, these graphs are practically identical. But what's the difference? Here, your max return is higher, your max risk is lower. Here, your max return is lower and your max risk is higher, right? So lower and higher, and then this is higher and lower. So you can kind of decide which one you'd prefer. But in my mind, I'm going to prefer this, right? Because yeah, you are paying up front, but it looks like in the future you can potentially make more. Also, your max risk is less. Where over here, yeah, you're getting paid up front, but your max return is less than here, and you could potentially lose even more, right? And again, these are both bullish strategies. And another thing to keep in mind here with the put spread is that you are selling this put. And I did make a video not too long ago on the risks of that because there has been instances where this put that you buy that serves as protection from the put you sold sometimes expires worthless, but this doesn't end up expiring with it. And then, you get exercised on and you're forced to buy 100 shares at the strike price without protection with the put you bought. Right, so this can be kind of dangerous, and it has been dangerous. People have lost more than what their max loss was supposed to be, simply because this expires and then this gets exercised at the last minute. Over here, that can't happen. Okay, if someone exercises this call that you sold, you'd actually end up making $500, right? Because you would end up selling your shares at $80 a share, but this call that you bought lets you sell them at this price, right? So you'd buy them at $75 a share, but then you'd sell them at $80 a share, and so you'd make $500, right? So that can't happen with the call debit spread. But again, these are basically the same trades, right? So that's kind of something you should take a look at, right? When you're doing a put credit spread, call debit spread, right? What happens if I graph both of them the exact same? Like, do I make more with one? Do I potentially lose more with one? Because in this scenario, this to me makes more sense, right? And this is what I would probably go in on rather than this one. I think there's more risks involved with this one. But again, that's strictly my opinion, but I just want to share this with you guys. So, if you're trading spreads, let me know in the comment section below. Let me know which one you prefer, and if there's something I've missed or, something I didn't explain as well, also let me know. But anyways, guys, hope you enjoyed the video. Again, if you want to join my Discord, link to that is in the description below. Again, we have a free version and a premium version. Also, if you plan on using Robinhood in the future, feel free to use my referral link in the description below. If you sign up using my referral link, both you and I will receive one free stock, which is basically free money for both of us. So let's help each other out, guys. And as always, I hope you enjoyed the video. I'll see you guys next time.